Boy, what a sexy hunk of man meat. Welcome back to Strong Man Personal Finance, everybody. My name is Christopher Belly. I'm a certified CPA accountant. I'm a fake boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And we got to talk about me, Kevin's favorite stock, bro, SoFi. So if you don't know what SoFi is, I'm going to show you. But imagine every financial product known to man. SoFi offers it, okay? Basically everything. It's a one-stop shop for all of your finance needs. So SoFi is, I guess, what you would call fintech, okay? It's all about the future, and you can have this app on your phone. You can do anything you want. But look what they do. They have investing, personal loans, student loan refinancing, banking with a 1.8 APY account, mortgage loans, credit card, private student loans, blah, 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 blah. Basically freaking everything. Now, I did check, and they are FDIC insured, and they have SIPC. So they are 100%, like, it's not a scam, basically. I mean, it could be a scam, but I believe they also have a banking charter. So let's go ahead and read about the officers, okay? Now, the first thing that I'm worried about in this company is we have the CEO here, Anthony Noto. Chris Lapointe is their chief financial officer. Where's his CPA license? Just kidding. Let's go check out the earnings. So the story with SoFi is that it's growing very rapidly. But as you all know, I don't like companies that are unprofitable. And SoFi is still very, very uncomfortable or very, very unprofitable. And you know a company is unprofitable and they try to make themselves look good by using non-GAAP, non-generally accepted accounting principles, such as adjusted EBITDA, or as I learned today, adjusted revenue. What that means, I don't freaking know. I know what revenue is. You perform a service or you deliver a good, that's revenue. That's according to accounting. Adjusted revenue is apparently something that they use as a metric here. Whatever. So let's go ahead and read the intro. We delivered another quarter of great results with robust growth in members, products, and cross-buy. We generated record adjusted net revenue, which was 50% year over year, and our 8th consecutive quarter of positive adjusted EBITDA. Tells me they're not profitable. Blah, 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 blah. So we can see their actual GAAP revenue. This is their GAAP revenue year over year is up 57%. That's pretty big. Look at their net loss for the first 3 quarters of 2022, $95 million. Now, I believe the stock popped after earnings, because I guess they beat expectations, but I don't know. It's just it's an unprofitable company. I don't understand how these people value these things. Okay. Let's see what the profit margin is. Negative 26% profit margin for the most recent quarter. And let's see what their last year's quarter was. Negative 71%. So they are improving their profit margin, their bottom line margin, but they're still unprofitable. Okay. And their adjusted EBITDA went up 81%. So let's go ahead and actually look at the financial statements. So before we do that, they also have what's called a member here and products. Now they actually have a specific definition of members, which we'll go look at in a second. But you can see they have member growth. So let's see how much they grew their members in one quarter. 11%. They grew their members by 11% in one quarter. And then the quarter prior to that, they grew it by 11%. And then the quarter prior to that, they grew it by 17%. So their member growth is slowing a little bit, at least the last couple of quarters, but that's pretty quick growth. If you compound 11% out, they're growing pretty quickly, all right? You can see they also have product growth as well. So let's go look at the definition of what a member is, because, they always show you these metrics. You want to at least know what they mean by member. So let's go down here, past all those dumb things like financial statements, and let's see what a member is. We refer to our customers as members. We define a member as someone who has had a lending relationship with us through origination and or ongoing servicing, opened a financial services account, linked an external account to our platform, or signed up for our credit score monitoring service. Once someone becomes a member, They are always considered a member unless they violate our terms. Now, that's a little weird to me because somebody could just I know they still have this like deal going on where if you deposit a certain amount of money into their bank, which has a bank charter to my understanding and is FDIC insured, check the website for yourself, of course. But somebody can just link their account and then they're a member. But what if they don't do anything after that? I don't know. That's kind of weird. So keep that in mind. They're going to use these definitions here, but you really need to use other metrics to really determine what their actual growth is. I mean, they did have impressive revenue growth. So reconciliation of adjusted EBITDA. So here's what I mean. Okay. Now, EBITDA, like I said, is this non-GAAP. It's not according to the rules of generally accepted accounting principles in the United States. So what they do here, you can see it in full force right here. They say, okay, our net loss, according to generally accepted accounting principles, which tries to match, revenues to expenses and requires you to do write-offs sometimes, one-time write-offs. Their net loss was $95 million. And they add back interest. Who cares about interest? Tax. Who cares about taxes? Depreciation and amortization. Depreciation is when you spread the cost of a tangible asset over its useful life. It actually reflects capital expenditures. They're not free. And amortization, that's intangibles, like patents or trademarks. Share-based expense. 80 million. Transaction expense. Let's just add that back too. Servicing rights, change in valuation inputs are okay. That's a subtraction, and residual interest classified as debt. So you can see they do all this mumbo jumbo. Oh, I'm just not going to count these expenses, and oh yeah, look, we have positive EBITDA. Stupid. Let's go look at their financial statements. Okay. Now, let's look at the year over year. Well, this is for 6 months. 6-month change in their assets. So they got a decent amount of cash, a little bit more restricted cash for whatever they're going to use that for. Investments in available for sale securities. Available for sale securities, those it's basically a middle ground between securities that are held to maturity and trading securities. And their income and losses get allocated to other comprehensive income. They actually don't hit the income statement. Loans, less allowance for credit losses on loans. Okay. We can see they've had a massive expansion in loans. That is looks like their number one asset. Now, my question, this is something you need to look into. I'm not buying this stock. Surprise. Who are they lending to? Are these good loans? Because the loan, when an institution lends to somebody, that's the institution's asset. And it's the other person's liability. For every asset, there's a corresponding liability. Here, they had a massive explosion in loans, but you got to ask yourself, how good are the loans? Because they have an allowance for credit losses, right? That's at management's discretion. The management and the accountants basically kind of figure out which loans or what percentage of the loans are going to be bad. So the number one risk I see with this company is these loans. Like who are they lending to? Are they credit worthy? What's going to happen if we actually go into a recession? Or a lot of these people going to default? That's what you have to worry about with any of these kind of like banking institutions. Because think back to the financial crisis. Oh, we have a bunch of securities, mortgage-backed securities, and they're AAA, yes. And then they turned out to be worthless. If that were to happen to this company, it would implode 100%. All right. Servicing rights. I don't know what that means, being honest. Securitization investments. I don't know what that means either. Property, equipment, and software. Okay, they bought a little bit more equipment. Goodwill. They had an acquisition. How do I know that? Goodwill only goes up if you acquire another company for more than the fair value of its net assets. Basically, what that means is you paid more for the company than it's worth on the market. Okay, that's goodwill. So they did an acquisition. They had pretty big increase in intangible assets, operating lease right of use assets. Looks like they potentially didn't do any new leases, and other assets. Less allowance for credit losses. So it looks like these are more, lending products. Liabilities, yeah, it's like a bank. Deposits, when you deposit money into a bank, it's the bank's liability. Because if you think about it, you can rip the money out at any time. It's not the bank's money. It's your asset. It's the bank's liability. So we can see they have deposits and there were none because it looks like they just got their banking charter. Okay. Accounts payables up, whatever. Operating lease, not high, not much higher. Debt went down and residual interest classified as debt. So looks like debt went down, long-term debt at least, it looks like. And, well, their total debt went up. Let's see. Oh, yeah, it was the deposits, duh. So their long-term debt went down a little bit, but now they have more liabilities because of the interest-bearing deposits. Let's go back and look at their cash. Interesting. So let's go look at their stock. How many stocks have they issued? Okay. Now, when you're looking at a balance sheet, you want to look down here under, I don't know why they have temporary equity and permanent equity. Sometimes these people just like, I don't know. You want to look for shares outstanding. Shares outstanding. Outstanding shares is how many shares are held by the public. Authorized shares are just shares that the company can issue at some point in the future. That does not mean that they're out there in the public. If you see a growth in outstanding shares, that's when you are getting diluted. Okay. So they have, over the course of, let me make sure, 6 months, they have diluted roughly 11%. 11%. They're diluting. They're issuing shares. I guess they need that cash, and they have an accumulated deficit. So this means there's, if you add up all the profits and losses going back to the founding of the company, they have had a net loss for investors of $1.389 billion. Okay. Let's look at the statement of cash flows. So they had a net loss for the 6 months ended June 30th, 2022. I'm looking right here. They lost $206 million on a GAAP basis in 2022 so far. And we can see, what is the biggest add back? Share-based compensation. Yeah. Okay. And of course, on a statement of cash flows, you have 3 sections. You have the operating activities, you have the investing activities, and you have financing. Operating activities is what the business does. It's the operations of the business. Now, SoFi has a bunch of products, but basically they give out loans, they offer financial services, blah, 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 blah. So you're going to see on here under operating, they have originations and purchases of loans. And you can see it's a negative number because they're giving out loans. Cash is leaving the business. They're lending people money, and they get interest income back. And then eventually the principal gets repaid. But you can see what they're doing is they're adding back. You start with the GAAP loss, and then you add back non-cash expenses, or you subtract non-cash gains, and then you do adjustments based on change in operating assets and liabilities. That's basically, it's called working capital. That's all you're doing with this. Next, you look at investing activities. Investing activities is buying property, plant, and equipment, for your business. It's not the operations of the business. It's buying long-term assets, or maybe assets where you park your money in, like treasuries or whatever, and acquisitions. So let's see. They purchased some PP&E. They purchased some available for sale investments. They sold some investments, changes in loans and net. Interesting why that's there. Proceeds from securitization investments. I really need to look into what that is. Acquisition of business, net of cash acquired. I wonder if they acquired the business with stock. Because normally when a business acquires another business, they're spending cash. It should be negative. So what I'm guessing is they probably purchased this business with shares. That's my suspicion. Whatever they bought. So we can see they spent some money on investing activities. Oh, and one more thing. They burned in 6 months $2 billion of cash. $2 billion left the business basically, for operations. So the only way to get that money back is you got to borrow money or you have to issue shares. So just keep that in mind. So we go down to financing activities. And oh, look, they had over $2 billion come in of financing. Proceeds from debt issuances, repayment of debt, net change in deposits, and proceeds from stock option expenses. So it looks like the vast majority of their financing came from issuing debt and net change in deposits. Yeah, banks are weird. They're weird, man. Like, I don't know. I don't know why deposits would be financing activities, but whatever. I don't do accounting for banks, I can tell you that. But it all kind of follows the same principles, but sometimes they have differences. So at the end of the day, let's see. Oh, here we go. Issuance of common stock and acquisition. Yeah, looks like they use stock to buy another company. So at the end of the day, I mean, this company is just burning cash hand over fist. They had good revenue growth. And I'm a little concerned about, or before I would buy this company, I would really look into who their freaking mouse works. Who are they lending money to? Loans, less allowance for credit loss. Who are they lending money to? I'd be really concerned about that because that's a pretty insane growth in loans. And if they're lending money to clowns, cheeks will be clapped. So that's my thoughts on SoFi, my blow-fi. It's very banky. I have a troll that makes fun of me because of SoFi. Fat man, why are you back? I do what I want, boy. Still got beef. What do you have beef about? Meat Buffy. Meat Bussy. How many tattooed chef meals can those fans fit in them? Rivian is announcing earnings. Let me guess, they lost a ton of money. This guy is so hard for Kevin, I threw up. I mean, he's young and handsome. What can I say? If you start making horse noises, I am leaving this chat. You gonna leave, bro? Huh? Yeah. Strong man building his own Tesla robot. Yep. I'm actually competing with Tesla from my garage. I heard Fuhad got busted by Chris. Oh, my God. Jeremy says he's interested in SoFi. Really? Of course he is. Oh, they're burning cash and they're massively unprofitable. It's the future, bro. If you're gonna buy this, look into those loans. I mean, I'm not gonna take the time out of my day to like, oh, what is the credit worthiness of all these people that are lending money to? Let's see. I'm naming my first son EBITDA. Did you guys see when I looked at EBITDA? Oh, let's add back this and this and this and this and this. Oh, look, we're profitable. It's so stupid. You don't understand. You haven't worked on Wall Street, bro. All the clown stocks talk about EBITDA. Have you noticed that? Have you noticed that, ladies and gentlemen? You were so right about all the meme stocks going nowhere. I don't know if you're being sarcastic, but yeah, the meme stocks have been wrecked. And then they get these little rallies like, oh my God, my stock's down 80% and then it went up 10%. I'm so smart. Well, let me remind you guys. Let's say you buy a stock at 100. It goes down 80%. Now it's $20. It goes up. It doubles. Now it's $40. You're still down 60%. But it went up. SoFi is the future of fi. I don't like, where's the moat? I mean, honestly, like how many other businesses provide all this crap? And honestly, like if I wanted to get a loan, like let's say I banked with SoFi, right? That doesn't necessarily mean I'm going to get a loan from them. You know, like maybe I can find a better interest rate, especially if I'm buying a house. I'm not just going to stay with SoFi if I can get a lower interest rate somewhere else. So, oh, it's all in one place, so everybody's going to use all their products. I don't think so. I want a job at SoFi. Does she work there or something? Uh-oh. Might get in trouble with Kevin. Buy VT. And yeah, well, I'm definitely buying VT over SoFi. Let's see. It amazed me how many people left Sleepy Joe to change the definition of... I don't even care. Oh, it's a recession. Oh, my God. Let's see. Heard Cole was trading in and out of SoFi. Said it was a guaranteed 10x. Cole... Did you do that? To be fair, Jeremy has had success in Tesla and certain stocks by holding long. Everything money has no proof. Fake day trade guru. You don't have the time. Okay, Lafufu was talking about Tesla like years before it ran up, and everybody's like, "Oh, Baba went down. Intel went down." I mean, I sold Intel. I'm not holding that, but you need to give it time. You can't just say they're trash because their stocks didn't 10x in 5 days. You're getting sexier by the day, you hunk of man. Thank you. I'm actually going to go lift. I'm going to do chest and triceps tomorrow. I've seen YouTube videos saying, hot, it's easy to get 100K loans and don't even need a job. There you go. I don't know. Yeah, I mean, I believe you. But you see what I'm saying? That's a big risk. That's the big thing that I noticed. I was like, okay, there's a lot of loans. Who are they lending to? It's a new thing. They may even be tempted to like pump up their numbers and lend to clowns to make themselves look good. Oh, look how many loans we originated. And they're lending money to clowns. So this is perfect. I like this comment right here. Very good comment. I look at SoFi as a boring, relatively safe stock. Not some super. It's not, dude. Look at the profit. I use SoFi. It's a good product, not a great stock. Yeah, I mean, honestly, like I'd be tempted to use it. It seems okay. I mean, it's insured, at least according to the website. So Jeremy's new video indirectly addresses you. Oh my God. Drama. Tattooed Chef's gonna go up tomorrow. Still trash. All right. Good comment. Bro, look up SoFi loans and it'll pop up. Yeah, I need to actually, maybe I'll do more exposés of SoFi. That'd be a good thing to look into. Student loans also a big problem for SoFi. Yeah, I don't really follow the whole student loan thing, but didn't they keep deferring the student loan payments? Something like that. It's like, oh my God. Uber is a better spec stock than SoFi. I said Uber is a buy. Well, yeah, Uber has less competition than SoFi. I mean, like there's like 1,000 different fintech companies. I mean, Uber, it's like Uber and Lyft are the only ones that I know about. I'm not saying go buy Uber. I'm not buying Uber, but when is the Omegle video coming? I'll do it. I swear. But, you know, this coming up week is earnings. I got a trash on Tattooed Chef, Palantir, everything. So I'm going to be busy. But I will try to do Omegle. I dumped Chris Insane months ago when you were exposing because I was losing my butt. Just sold a profit on Thursday. Keep doing what you do. And listen to my son. Thank you, Strawberry Girl. Nanalyze did a good job in SoFi and how bad it would end up. Wait a minute. I think I know who you are. All right, guys. Watch the advertisement. Sprytech. Great set of pants. And I'll see you guys tomorrow.